I used to write for Forbes and CoinDesk. Well, actually, I used to just research a lot of on-chain stuff for myself to try and figure out how to invest, and that led to writing for those guys. And so on-chain analysis, writing for those guys. I'm a partner at Adaptive Capital. We use some of these techniques and technical techniques to trade the markets. We don't buy shitcoins. We essentially take a position long or short. And I'm also an investor and advisor to Level, which is the latest US regulated exchange. And that's really merging crypto with bank accounts. We're going to offer banking and crypto all in one. Okay, now, I mean, we probably already know what Bitcoin is. I'll probably skip through that. Well, actually, yeah, often when we talk about crypto, everybody likes explaining how it works, and that to me is like explaining to someone off the street who just wants a cell phone how armchair works, right? We don't need to get into proof of work, block times, private keys. We just need to tell them that someone figured out something that could be put onto the internet which can't be copied, and because it can't be copied, we can store value in it like fine art. And so, you know, of course this is about fundamentals, so I'll go into this. This is the fundamentals of how much value is put into all of these buckets that we can store value in. Real estate at the top, I think it's 220 to 280 depending on the estimate, and all the money in the world is 90 trillion. Stocks 70, gold 8 trillion, and Bitcoin 0.15 trillion. Right, so that gives you an idea of how much value how much value there is out there in the world that can flow into this Bitcoin bucket, this digital scarcity that just sits on the internet. So, like, this is a very popular image I put up probably 2 years ago, and this is what I see is happening, is that we're going from you know, this industrial age money that was gold backed to nothing backed to now being pseudo-digital on banking databases, and now we've got something that isn't pseudo-digital but is digital at its native form that exists only on the internet and is programmable. So I see that, you know, cryptocurrency will be the money of the future. It's just probably some debate of how that plays out, whether it's going to be sovereign, you know, country states issuing stuff, or whether it will be Bitcoin. So this is how big it is right now. It's roughly 1% of the world population hold Bitcoin, and people say, are they using it? And I say, if they hold it, they're using it because they're using it to store value in that sort of bucket of value metaphor. And just down there, we grew 4 times in user base in 2017, and even in the bear market of 2018, it doubled. So you kind of can look at that and go, well, if the baseline is doubling every year, we're at 1%. If you continue that doubling on the kind of exponential upward phase of an S-curve before it levels out, you're kind of like 7 years. What is it? It's like seven years of doubling before you get to about 50% of the world using Bitcoin. So that's pretty astounding for a lot of people. And it's also the value of 1% of M2 money supply. That's kind of longer term savings accounts, not cash check or paper cash, for the world reserve currency. And this is it plotted on the chart. The fundamental growth of Bitcoin is astounding. We are here, right? We started off here at about $1,000 for all the Bitcoins in the world, now 150 billion, and now we've got to get to that 10 trillion, 100 trillion mark, which sounds astounding in a linear scale, but this is exponential on powers of 10 each step up. And it just turns out we cross M1 if we continue in less than 5 years, probably way less than 5 years if you count the sort of explosive bubble behavior we get before it comes back down. So, like, a lot of people have said how can you get 1000x? This is a Ponzi scheme, and my answer to that is we get it all the time. We always get this in technology. If you're a seed investor, any seed investors here in startups? Yeah, so if you get a hit rate's something like 2 to 5% at seed level to an IPO, you can turn something that's a very small valuation to a multi-billion-dollar valuation in 8 years. And this is actually what you see. It's the norm in new technology. And you see, normally the founders get in here, the angels come in at seed level, the venture capitalists come in and we're valued at 10 to 100 million. And then they want to see this sort of uptick in adoption before they get in. And so with Bitcoin, our equivalent founders were the cypherpunks. They mined it. Then we had the drug money and the libertarian money coming in this phase here. And these are the guys that got the 1000x. And it's interesting because the general public is now coming in 2017. And generally, where you see institutional money taking this part of the growth cycle, where you're starting to get an uptick in sustained adoption, you see the VCs come in here, but they weren't allowed to because the regulatory rules prevented institutional money coming in. So it's very unusual. You see the public coming in and getting this 1000x when the smart money essentially banned from it. Though, you know, some of those guys would have come in privately where the rules weren't established for individuals. So when you get this kind of returns, you do expect crazy volatility. This is a 60-day volatility for Bitcoin. 60-day volatility of nearly 100% price swing at back in the 2011 phase, and even now we're in the mid-teens, and still spikes higher. Like, what is that? Mid-teens, even up to the 30-ish%. And that means, say at 15%, take this figure, that means within a 60-day window, you've got roughly a 2/3 chance that the price will stay within that 15% band. And the other times it will be outside. So it's still a very volatile asset, but if you take into account the kind of gains we get with it, this is what it looks like with an apples to apples comparison to all the other asset classes. It's it by far outperforms everything, including stocks. So this is the risk-adjusted return over a 4-year investment period. You're going to hold the asset for 4 years. And the interesting thing to note here, if you're an investor, is that we're not a lot different here in 2019 than we were in 2015 or in 2014. We're like, a lot of people who are coming in this cycle think they're too late to the party, and they see these very, very rich people who got in early, and they think their opportunity is gone, and they go into very sketchy, high risky, the next Bitcoin kind of investment. But you got to remember, Bitcoin's risk is also dropping exponentially downwards as its growth is slowing down, and because of that, if you're an investor, you can allocate more of your portfolio into that to get the same return. Because you'd be crazy if you're going to put 100% of your portfolio or even 30% of your portfolio. You know, it was safe here to put maybe less than 1% into this crazy asset that was swinging around 50% in price over 60 days. So, and you had no idea if it would win back here. It was so early in the adoption phase. So we're actually in a very sweet spot here where it is growing very steadily. And the amount that you can get in terms of portfolio return by utilizing Bitcoin is very, very good. And also it behaves differently from all of these other buckets. Usually these buckets, these asset classes, you think of these buckets, they're buckets that people hold value in, they're gravitationally locked. Like a stock goes up, stock scale goes up, something else is going down because money's coming out of either bonds or the real estate market to go into that bucket. So they slosh between the buckets, and because Bitcoin's such a tiny little bucket, the big money is not being utilized for that management currently for portfolios. But that will change as the Bitcoin bucket increases, and it will start to get a correlation. But for now, the fact that it doesn't move like the rest means that if you're an asset manager, you actually do want to put some amount in there because it provides a little bit of a balance to your portfolio. It gives you more of an inverse correlation to what's happening with the rest of your portfolio. And so now I'm going to get more into the on-chain stuff. That was just a primer to some of the fundamentals behind Bitcoin. So obviously we know that this thing runs in cycles, and we're in our 4th cycle now. And as traders or investors, often people do these nice sort of textbook perfect cycles, like bull, bear, let's time it, we'll look at stretching, then we'll stretch it further and think the past will dictate the future. But if you look at actually what's happening here, it's so nuanced, right? I mean, here we had New Liberty Standard where it was pricing electricity. Mt. Gox came in, immediately the price pumped. Litecoin came, so we had a native trading pair. All this sort of stuff happened, right? And this created the first wave, Silk Road, and then Mt. Gox and the Willy Woo pump dictated the second phase. And I don't know if many of you remember what happened here, but Mt. Gox, which was trading 90% of the coins, they were hacked and they were short of coins, and they turned on an algorithm inside the exchange that started buying up the coins with fake buys without any backing, and that was what caused the second run up from, what was it, $100 and something to $1,200. And there's some evidence that might have been caused by this as well, but actually we can see on chain that there was no investment activity driving this part, even though the market ran up to that level. It all happened on one exchange, and then 1/8 of all Bitcoins in the entire network were stolen in that Mt. Gox hack. And so that created this very, very long, prolonged bear market. So this last cycle was a very, not this last bear cycle, but the cycle before that, the previous bear to bull market was a very long and protracted cycle where we had to recover from 1/8 of all coins being stolen, 90% of the trade volume on one exchange that got destroyed and the founder going to jail. And then we had scaling wars, like people wanting to increase the block size, and there was a deadlock. That deadlock lasted 3 years, and they didn't know how to get through that with the protocol. So this is all very nuanced stuff. And currently, right now, we're in this phase of quant funds, and there's data now showing they came in around here, and the market is very different now. Very robotic how the price trades. It's very dictated by regulations, institutional money coming in, and really the first inkling of sovereign wealth fund interest. If you're in the industry, there's some interest of that money coming in, and sort of the more innovative economies are looking at that. So it's a different world now from, say, this zone here, and definitely this zone and this zone. So it's very nuanced, and so reading a lot of this stuff fundamentally, it's often taking a lot of snapshots, but you also have to know what's going on in the real world. And this is kind of like quantitative fundamental analysis. It's not just reading the news, but reading the news, getting a take, and then seeing what the data is showing as well too, and try and figure out what the data is saying from the events that are happening. And so this is a very favorite technical indicator for traders over the long term, and it's the standard 200-day moving average. So you just average the price over 200 days, and wherever you get a bearish cross and it stays below there in a downward direction, then you can say that's the bear market. I can sell there, and I can wait for the bullish cross there. Okay, and there I sold high and I bought low. Right? And in Bitcoin's 10-year price history, it's always worked. There, it's there. It's a bit late to the party, but it works. There and there. Okay, so that's an interesting one for. And this is not using on-chain. This is just basic price, time, not even volume. And this is the 200-week moving average, which, again, it touches the bottom. So you can almost get a timing signature of when you're going to touch, and that might be a good time to buy. Again, has worked for 10 years. So these are technical indicators. Now, with the blockchain, we have essentially, with all blockchain, well, let's just look at this chart first. Do you guys recognize that shape? I mean, as Bitcoiners, we should probably know what that looks like, right? The red line is the market cap of, or network value, the market cap of Bitcoin. But it's hard to read because of the contrast on this projector, but can you guys see the blue line? That blue line is how much money.
You mean we can agree it?
Yeah, this kind of action here, this thing here. Do you see that? There's a blue line. It's very faded, but that is tracking the network volume. Essentially, the amount of capital being transmitted on the blockchain. And so you can see how tightly this correlates. You can even see where the value being moved between investors, because remember, this is an investment. There's people putting money in here to park it. They're not paying for coffee. Some of them might be, but it's $5. It's not $10,000, right? So this is tracking investor activity. And you can see when that investor activity dropped down, the price followed. And you see the opposite, right? And so I was the first to ratio the two. And we called this NVT ratio. And this was publicly tweeted in 2017 in October. So just over 2 years. 2 years, 1 month ago. And that for birth of the new field. There's now 5 companies in the space that specialize in providing on-chain data to quant funds. And so this is just the ratio of market cap to how much investment activity, the volume going through the blockchain. And it actually looks like a price earnings ratio. In the early days, it's a high NVT, a high kind of PE, very high speculative value compared to the underlying investment activity. And then now we get into this flatter band, especially after Mt. Gox entered here, and we started getting Litecoin here, and it became a tradable asset. In this area, it was very dominated by miners accessing it, very little trading. And now we have these nice oscillations, and wherever it goes down, the PE ratio, or that is low, that means that underlying activity of this company or the blockchain is very high compared to how it's valued. And in the bearish phases, there's not a lot of activity, and therefore it swings high. So that's a bearish reading. You want to see low valuation to high activity. And so this became a really nice indicator to a few years ago to try and ascertain where we were in the market from bull to bear. If you're a trader or even an investor, this is what you want to know. Whenever you see the chart do this, you're in a nice support trend line, you get on this nice bullish run, and you get a peak. And whenever you get a massive drop, it bounces. It often oscillates, always does actually. And then what you want to know is this thing just consolidating? We've got overheated here, and then we need to consolidate, catch our breath, and then get the next wave up. Or is this actually the top and then we get a crash. And that was a dead cat bounce and not just a consolidation bounce. And so what NVT was good for was to tell what was happening by looking at the underlying blockchain ahead of time, right? And so here's an example where at this point we shot up to $258 on the daily close, and then we dropped down to $45 on the daily close. Actually, we lower on the hourly. So this is a 83% drop in the markets, right? If you come from Wall Street, that is absolutely carnage. That is what I think the Great Depression, the Wall Street crash of the Great Depression was worse than that in totality. But Bitcoin did this in a matter of days, and now you got to ask, is that a consolidation? And I tell you, just about everyone in the markets there said, no way, that's dead, 80% drop. But if you would look on the blockchain, you see that it's well within band, and there was a massive amount of investment activity to support the price, and that's what we got. We did another run up. That was the top. This was not a bear season. This was a mid-bull season correction, right? And so NVT told you this. Now you're in this point here where you're getting another top, dead cat, coming back up for a retest, and then you look at this and you say we're out of bounds. The investment activity's dried up. All the buyers have left the market, and there's not enough transaction volume. So at that point, after this retest there and it bounced back up, you know that to get out. And if you remember on the 200-day moving average, there, you would have got out there. NVT tells you to get out there, right? So by using the blockchain, we get a much more intimate read of what's happening with investors, and you can close out your position as an investment, having been in it from, say, here. This would be a good time, or here. You can get out here rather than waiting for the here. Right? And these are longer term trades over many years, like 2 years. And this is the thing with blockchain, is that we're not getting hourly, we're getting many days, weekly, monthly time frames. The longer term fundamental reads. The short term price action is determined by traders on BitMEX. The exchanges control the short term price. It's the derivatives exchanges that control the short term price. The spot exchanges like Coinbase, Kraken, those guys control more of a longer term read, and the blockchain gives you the longest. And also, the more reliable reads are the longer term ones. The blockchain read is more reliable than the exchanges, and anything that happens on the derivatives exchanges is just a game. So whatever you try to do, you'll get taken out by the bigger guys that will trade against you. So it's kind of a random walk on the short-term price action, and I wouldn't say it's a random walk. It's a very deliberate walk to milk the most money from most of the traders. And so I posted that in October, and 3 to 4 months later, Dmitry Kalichkin, I think that's how you pronounce it, he did a variation called NVT Signal, and that was instead of taking the ratio of one to the other, he 90-day averaged the blockchain side of it, and then did the ratio to the raw market cap, and you get a different type of shape and much sharper peaks. And like I applied a bit of trader analysis, pretty much the trend line break, and that was very, very good. It was like, if you were using this, you would have got within something like 1 or 2 days of the 2017 peak. Like you would have got out at something like not far off the 20,000 mark. It broke trend line and it came down. And conversely, when it breaks up and it's oversold, you can do a bull read and go long. And so you can also use the absolute values there. So I mean, that shows you there that that were oversold. And I mean, I rose on Twitter a lot. I got a lot of reputation on Twitter by using his indicator. I did 13 price calls on using NVT Signal on Twitter over the course of 18 months. And 12 of them were correct, and they were posted always in times when the technical indicator said the other way. And I wanted to do that to show this stuff worked, and that I wanted to be contrarian to the technical read when the blockchain read was the opposite. So that was 12 out of 13 correct calls, and then Unchained Capital came up within a month and a half later with their HODL Waves, which this is just a map of how old the coins are sitting in the waves. And you can see these waves happening as investors move in and out of capital. These are the longer term wallet contours, and this is the 1 day. This is the amount of coins sitting in wallets that are less than 1 day old. This is 1 week, 1 month, and so forth. And so again, you can kind of see, like, if you're coming off this bear market, these waves coming down, 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 and as you start to see this uptick, you can take a guess at what the macro market is doing, where you are in that.
Those lines are?
This is the percentage of coins in wallets by age contours.
By
Age contours. How long have those coins been in the wallet since they last moved? Right. So here, this is I think this is a 5-year contour, right? No coins were older than 5 years, obviously, because the network's not 5 years old at this point. At this point, this is the 5-year birthday. So these are the percentage of the network coins that are over 5 years they have not moved. And you can see that it's going like this, and these are probably the lost coin count, except for here you see that reduced. So some of those 5-year coins moved and they haven't been lost. And so it's using this kind of analysis that you can get an estimate of, I think the estimate's about 4, possible, is it? Oh, sorry, what is it? It's like, does anyone know? It's like 2 to 4 million coins are lost. I forget the exact figure, but there's a pretty accurate estimation. You can do it using this kind of analysis. You can see how the contours start to compress here. And so there's a change of activity where not much it's expanding, where you could possibly, I think you could possibly look at those contours and take a guess that this percentage of coins up here above it, that line, may be subject to being lost because the trend just took a change at this point. The other thing that some guys have done are they take one line contour and then they do ratios with the other. And I'll just explain, like here, this is the, for example, 1 day. This is like the coins that are sitting in wallets that are less than 24 hours old. That means they've moved in the last 24 hours. So that is a proxy to the amount of volume moving on chain in the last 24 hours. And this is a proxy to the coins that are moving in the last 7 days. And it'll ignore the fast turnover where it's hopping between different wallets. It's those coins that have sat there for 1 week or more, at least 1 week. And so this is starting to trace longer term investment activity, whereas this is showing more tracking the volatility of Bitcoin, because if it's volatile, one moves to the wallet to the exchange wallet to trade, whereas this tells you more of the investment activity that's happening. And you can see that there was a massive spike here, and that's starting to correlate to the bottom because investment activities is moving. And we got better indicators than that, but this is a fundamental that you can grab some of this data and mash it up. And then Nick Carter and his team at Coinmetrics came up with one of my personal favorites, which is realized price. And realized price simply says this is what the average market paid for their coins, right? And you can do this with Bitcoin because you know when those coins like last moved. So you can just take an estimation, an assumption that when it moved, that's when they bought, and let's take the price and figure out that's what they paid for those coins. So you can do that for every single wallet on the entire network, and then that's what you get. And you can see that when it's below realized price, the investors are underwater, and when it's above, they're above water. And it's almost like this crossover between when you're below, you're in an accumulation phase, right? There, and there, and when you're above, you're up and away into the bull market. So it's a very good indicator. The market is not underwater in Bitcoin very often. And so my colleagues, David and Murad at the fund, did the ratio, like I did the ratio of NVT. They did the ratio of realized price. So again, a lot of this on-chain analysis is give me something that's fundamental to the network and ratio it with what the market's saying, the price. And let's see if the market valuation, how that stacks up with the fundamental activity. In this case, the fundamental activity is what people pay for their coins. And this is really nice. You know, you can see at the top, you're reading the tops of the market here very accurately, and the bottoms, right? And you know where in the trend line between top and bottom you are. So these are becoming very, very useful indicators to signal where we are in the macro landscape between the bear, the bull, and the bottom in between. And so, you know, like Awe and Wonder, I think he's gone off the scene now, we don't even know his real name. Actually we do. But he Z-scored it, so basically stretched and compressed these peaks so they become very normalized using a Z-score, which is based on standard deviation. It's a statistical measure that, or technique you can use. And this, again, this projector is way too bright, but in my screen, there is actually a red band and a green band, and you can now start to say if you're in the green band buy, if you're in the red band sell, and that'll tell you, like I'll show you right here on my screen. My screen there, you can see that? That's where it said buy, and it said sell there. Pretty much at that point, right? It's pretty good.
What ratio is this? What does this say?
This is market value, which is the market cap, to realized value, which is the previous slide, what people pay. And all our terminology is really screwed up. Like, I think we used to call it market cap, and then I think Chris Beniski said in his book, you know, under discussion with a bunch of people doing this stuff, I want to call it network value because it's not really a market cap. It's not like Wall Street. And then so now we've got, you know, market value, network value, and now this is, it's, you know, it's just very confused, the terminology. And so another guy, Philip Swift, British analyst, ex-advertising, he started to get into crypto, and he just pretty much plotted this on Twitter, and I liked it and I put it on my site. And this is essentially just the share Bitcoins being moved on the network. And it's a nice visualization, I like it a lot. You'll see that the investor activity moves the market. That moved up. And so, and you need this sort of plateau to sustain the bull market. And when it drops off, watch out. There's actually an economic formula you can use to determine the underlying activity, the velocity of the network and its market cap. It's very fundamental, and actually, because a lot of people thought this is just a coincidence. Why is the volume tracking the market cap? But when you get down to the equations, the two should track each other. And so, I'll tell a little bit of story, is that I was really bearish here, and it collapsed. And at this point here, I was still bearish. I switched from bearish to bullish about here. And I was publicly bearish for a while, and that was based on the amount of volume going on the blockchain. And it turned out that the data we were getting was from this company, blockchain.info, who did some of the first charts in Bitcoin. They did a volume estimate. They obviously had a lot of data because they had the largest used wallet for its time. It was weird. The volume was drifting lower and lower and lower. And I went back, and because we had a lot of indicators. We had this, we had a lot of proprietary indicators, and anything that was not based on the sheer volume moving on the blockchain was starting to turn bullish. Yet anything using volume to read the market was still massively bearish. And my price modeling was showing down into the mid 2000s would go based on volume. And so one rainy day, I decided I want to double check the data we were getting from blockchain.info. So I grabbed this HODL wave, the 24-hour coins called Younger, and used that multiplied by market cap, and therefore you should have a proxy to the volume, right? This is how many, multiplied by the supply, because it's like fraction, what percentage, multiplied by supply, you get the coins that are in those wallets, multiplied by the price, and you get the USD volume going through the blockchain. And there was this massive deviation between one metric and this data we were getting from blockchain.info, and I knew that they were drifting. And at the same time, Bitcoin Metrics gave us their new estimate, and they were, one of their co-founders worked at blockchain.info, and they recreated and improved the metric, and they gave us this new volume estimate, which solved the mystery, which was like, oh, okay, it's not actually that bearish, the bottom's in. And there, the resolution was so good that you could even see this bottom fractal coming, where you had this 1, 2, and before the 3 a little inversion, and that was the capitulation. And you saw that on the blockchain, and that gave us like this perfect fractal of investment activity, showing that's the pattern for a market bottom. And so, anyway, we've done a lot of different work. This is NVT Price, which is taking a lot of the volume and mapping it back to price. You can see, see where it's sort of, yeah, I should warn, a lot of this volume-based stuff and on-chain stuff is changing a lot, and a lot of this stuff I don't like anymore. Like this one's a top and a bottom. This one uses a price model around destruction, which is it takes into account the volume that's moving between investors, but also weights it according to the age of those coins. So if it's a big transaction, that transaction is worth, say, 5-year-old coins, that's much more significant than a young transaction where it's just hopped between wallets. A whale that's been holding a long time, moving their coins, is much more significant and much more bearish than this younger activity, because those are experienced coins, so to speak, smart money. And so this one uses that model, and so we have models for top and bottom, and we're in this range here, kind of 1/3 of the way towards the top, and you can even get an estimate of what the top is. This top is actually a dotted line, it means it's a technical indicator. It doesn't use blockchain. All it does is takes the average price of Bitcoin since its beginning and multiplies by 35, and it just happens at the top, and we don't know why, except for this fluffy term called mean reversion. Mean reversion is just saying everything trends back to the moving averages. And that's what the 200-day moving average is. When it goes too fast, it's overheated. And so these are some of the models. I think that's all I really. I want to say a few things. Maybe I'll just go to the browser and pull up some stuff. Like, this is where you can probably turn off the video camera.
Okay.
Thanks.